ridiculous. We're going to only take a small section out of it.
Okay.
So while we're doing that, I just ask everybody how their method of trading is working out for them. Okay? How is that working out for you? And
we had 70% doing covered calls and 61% doing long calls and 61% doing vertical spreads and diagonal spreads. And over the last 12 months, what's your feeling about that? How has your performance been, in your own opinion?
That's right. We're just going to leave that up for a few more seconds, okay, because I think folks are going to answer it pretty quickly. And Mike, I predict, I'm not sure what's going to happen right now, but I predict that we're going to have a classic bell curve.
Yes.
We almost always do, where there's very small number of folks answering at the extremes, at the top and bottom. And in the middle, that's where the bulk of the listeners are finding themselves. And it looks like I'm probably right. Look at this. It's almost exactly a bell curve right there. Let me see if I can stop this at just the right time, okay, as folks are coming in. And pow! Okay, now not everybody did their vote, okay, but that poll was up for some minutes. So, Mike, look at
that's
that.
about as bell curve can be, isn't it?
That's bell curve as you can get. All right, so Mike, we've got those folks in the upper 3% that are saying, "Man, this is great. I'm only here out of curiosity. I'm doing so well, it's ridiculous." 3%. I am a very happy trader.
Mm-hmm.
Of course, on the other end of the spectrum, the other extreme, we've got 3% that are saying, "Look, I'm ready to quit. I want to throw in the towel."
Mm-hmm.
Okay. All right, and then in the middle is the vast majority. The vast majority. Let's take a look at the first 20%. Say, I'm making money, but not enough. Okay, I'd like to see some better returns. 38% have mixed emotions. I see potential, but there's some problems here. We need to fix. Okay, we need to get this figured out. All right, and then 28% say, "Wow, I lost money last year." Okay. So let's talk about the solution. What we're going to do is going to be the first here of 3 different webinar shorts. Okay, and I'm going to start off with right here in the middle. We talked about Mike Warren Buffett is credited with this, but he actually didn't come up with this saying. He was quoting a book that was written in the early 70s. But what Warren Buffett said at an annual meeting of stockholders one time, he said, if you've been sitting at a poker table for 15 minutes and you don't know who the Patsy is, get up. Because you're the Patsy. That's the deal. Now, here's the deal. I don't want to look at anybody and call them a patsy. I've played the patsy. I know that you have also been in a position at one point or another in your life, Mike, where somebody maybe took advantage of you, and it's not a good feeling. But the thing is, everybody has played the patsy, and there's no shame in that. What there is shame in, though, is continuing to volunteer when you know what's going on, right?
Yes.
You don't want to do that. Okay, so we're going to talk about this. They say cut your losers short and let your winners run, Mike.
Yes.
All right, so let's go take a look at this table, okay? Sitting at this table, there are cover call sellers, okay? There's the call buyer, right? There has to be somebody buying up these calls. In order for you to sell cover calls, okay? And then, of course, there's the market maker. Now, this is an oversimplification, all right? But let's just say we're sitting at the table where calls are being bought and sold, okay? So, if it was Vegas, Mike, the house would have to make some money, right?
Oh, yeah.
Okay. In fact, they're going to make money no matter what. And then, of course, some savvy players. There's going to be some savvy players in Vegas that are also going to take some money off the table, and they're not affiliated with the casinos. Okay. Some folks actually do make money. Not me. I don't even volunteer. When I go to Vegas, it's to visit my father-in-law and not to play the tables. I'll watch shows, or, go eat and stuff. But no, I don't even sit at the tables because I know that I'm going to be the vast majority. The vast majority is who finances the other two, right?
The Patsy, right.
The Patsy. Okay, that's who I would be. All right, because I'm just not a savvy player.
Mm-hmm.
All right, so there's the house, there's a savvy player, and then there's the Patsies. Well, Mike, let's talk about the situation at this table where calls are being traded. The underlying stock is at $50 a share.
Okay.
Okay. The $50 call options are selling at, they're bidding at $1.80 and they're asking at $2. And we've got three players all starting with $100,000. Okay? All right. Now, the covered call seller, he would be able to buy 2,000 shares of that $50 stock, right?
Yeah, investing his full capital.
Right. And then he would, of course, be able to capture some premium by selling those 20 calls. And what's he going to get if the bid is $1.80?
Well, let's just assume he does the natural bid price. Let's not worry about midpoints right now. So they collect $1.80 times the 20 calls. That puts them up at about $3,600, correct?
That's right. He's going to bring in $3,600 for doing so.
Mm-hmm.
All right, and let's also talk about another feller, the long call buyer. Now, the long call buyer is going to do things a little differently. He's going to structure his investment in such a way that he can't lose more than 3.6%. Okay? He can't lose more than 3.6%. Instead of, he's going to pick up 3.6%. Okay? So out of that $100,000, he buys 18 calls at the ask price of $2. Okay? Now, does that work out mathematically? Do we have the 3,600 going in?
Yes, we do. We just kind of reverse it. Instead of selling 20 calls at 180, we're buying 18 calls for $2.
Okay, so I got a question. Where's the other two calls go?
Well, see, now the market maker is still in between the two, isn't he?
Yeah, he's a trader too, and a lot of people overlook that. Okay, a lot of people overlook the fact that the market maker is also a trader. All right, so here we have the long call buyer. He has spent $3,600 for his 18 calls at $2.
Mm-hmm.
Now the covered call seller on the other end of the transaction, he picked up that same $3,600 by selling 20 calls at $1.80. But there are two calls that are missing, and it's the market maker that gets them. Okay, he gets them for free, by the way, because the market maker is in a very unique situation where he gets to buy at the bid and sell at the ask.
Mm-hmm.
And that every time he does that, it's kind of like, I'm doing this broadcast. Normally I broadcast from my home office or from my studio, both of which have internet connections. But today I wanted to have a hot drink next to me the whole time. So I'm at a coffee shop, and at that coffee shop they have frequent filler discounts.
Sure,
okay?
sure.
Every 9 coffee I buy, every 9 that I buy, I get one for free. Well, look at this. Every 9 calls that this market maker sells, right, he gets to buy one for free.
Mm-hmm.
Because there's a 20-cent spread. Do you see that up there? The
yeah.
$1.80 by the 2?
Mm-hmm.
Okay, and so he brokers 9 transactions, right, or nine calls. He's left with $1.80, and then he can take that $1.80 and buy at the bid.
Yes.
Okay? And so for every 9 calls that move, he gets one free. And since 20 calls or 18 calls were bought by the long call buyer, he gets to have 2 of them. Okay, now do we have a totally balanced sheet? CW, by the way, stands for covered writer.
Okay.
All right, covered caller, covered writer.
Mm-hmm.
Okay, he sells 20 at $1.80. Okay, the long call buyer buys 18 at $2. Okay.
Right.
And the market maker, I'm going to say that he owns 2 because he didn't really buy or sell it. He just kind of acquired it.
He's controlling 2 calls, yeah.
Exactly. So he has a $0 cost basis. Okay. So, is everybody with me so far? I hope so. All right. So the stock goes to $55 a share. What's going to happen? Those $50 calls are going to be worth $5 on expiration Friday. Okay. What happens to the covered writer, Mike?
Well, the covered call seller is going to get assigned without putting more money in the position. They will have to deliver their 2,000 shares of stock at 50, but they keep that $3,600. So they're going to realize a profit of about 3.6% on their investment.
Right on. Okay, the long call buyer now, he's able to sell his 18 calls at a $3 profit. If you recall, he bought it for $2, right? And now he's selling for $5. So there's a $3 profit on 18 calls. So did he do well?
He did extremely well. If you look at his investment, he made a profit. He took in now about, he made a profit, $5,400, right?
Right, okay. And then the market maker, now he's got those 2 calls that he's able to cash in his chips, take $5 off the table because that is $0 cost basis. So now at this table, okay, he makes $1,000. Now keep in mind that market maker is brokering a lot of transactions.
Yeah.
He's hooking up a lot of long callers and a lot of covered writers. Okay, so he's going to do much better than this. But the fact is, his position in this, Mike, was that he couldn't lose. Right? He was what I call bulletproof. He couldn't lose.
Yeah, he didn't really put up anything for those long call positions, right?
Yeah, but he could win. Okay. Later on, we'll talk about how we can make ourselves bulletproof. But just for right now, let's just talk through this. Okay. All right. So, Mike, did everybody win at the table?
Well, yes. In this case, stock went up. Everyone made money.
That's right. Everybody at the table was bullish. The person that's a covered call writer, he's bullish, because the main portion of his trade is the fact that he's buying stock, so he better be bullish. Right? And then there's the long call buyer. Of course, he's bullish, and the market maker played this bullishly. All right, so everybody won. That's marvelous. So let's do it again. Let's assume that we have the same setup again, Mike, next month.
Okay.
The $50 calls are selling at 180, and they're that's what they're bidding at. They're asking at $2. The covered writer does his same situation. Long caller does his same situation. The market maker does his same. Got it?
Got it.
But instead of going up by 10%, this time the stock has gone down by 10%. Is that plausible?
Of
Is that
course.
something that can happen?
Absolutely.
Yeah. Okay. So those $50 calls are worthless on Friday, expiration Friday. Our long call buyer is going to lose how much of his $3,600 investment?
Well, the long call buyer is going to lose all of it. Those options are going to expire worthless. We have no value remaining.
Right. So he's lost 100%. But he's lost 100% of his 3.6% that he invested. Okay, so this is called structure. This is positioning. He didn't bet the whole farm. Now, could he have invested in too many calls and be completely cleaned out?
Oh, yeah. With $100,000 on hand, he could have bought 50 call contracts at $2, right?
Yeah, and he could have gotten hurt very badly. Okay. All right. Now, the market maker, he doesn't lose anything, does he?
No, he didn't really have to pay anything for those calls. He just has 2 assets that expire worthless that he didn't really pay any money for.
That's right. Now, the covered writer, he keeps his $3,600, right? But let's be real honest, okay? If he liquidates his stock right now, which he probably should do if it continues down, okay? Or I should say before it continues down. All right. But if he liquidates right now, his loss on the stock is going to be 10 grand. Remember, he had bought it at 50, and now it's at 45. It's 2,000 shares. Okay, $5 loss times 2,000 shares is $10,000 loss. Okay, so he's gotten hurt here. Now, Mike, you've heard this before, that trading is a zero-sum game, and it's true. Let's see where everything got allocated. The long call buyer in the first play that was bullish, okay, where he made money, he made $5,400. He lost $3,600 on this last play. Right?
Okay.
So does he have a net gain?
Yes, he does. He's up $1,800 still, right?
That's right. The market maker, he makes $1,000, okay, on the winning play. And on the losing play, of course, he loses nothing because he has no skin in the game. Okay, so is he still ahead?
Absolutely.
Okay. Now the covered writer made $3,600 on the first play. You could argue that he made $3,600 on the second play, couldn't you? But,
sure.
Yeah, but you'd have to turn a blind eye to the fact that, well, okay, he took the credit of $3,600, but the stock is down, and the stock is down to the tune of 10,000. So let's not turn a blind eye to that, and then our sum is going to come out the way that math really works. Okay, so he lost 6,400 on the second play, right?
That's right.
Gained 3,600 from selling the call and lost 10,000 from the stock. Okay, so here's the deal: the covered writer picks up the $3,600 that the long call buyer lost. And the long call buyer and the market maker picked up the $6,400 that he lost. See that? Okay. The $3,600 that the covered writer profits by, he profits because of another's loss. And his loss contributes to the gain exactly dollar for dollar of the other two players. Remember what I told you in Vegas, all right, the house is going to make money every time, and some savvy players are going to make money, but it's the patsies that are going to finance that. Now, Mike, am I suggesting that everybody that plays covered calls is a patsy?
No.
No. No, I'm not suggesting that, but I am going to say that this structure, the market maker structured his account correctly, and the long call buyer structured his account correctly. Did he put every single dollar that he had into his long calls?
No, not at all. He properly was only risking about 3.6% of his total portfolio value on that position.
Right. Yeah, but the unwise structure here was the fact that in order for the covered call seller to pick up what the long call buyer loses, he did have to put in his whole investment. Okay, his whole capital. All right, and so it's the structure that made him the loser. Okay, the long caller, the savvy pro, made money. The market maker made money, and who was able to finance everything for everyone?
Well, that would be the market maker, wouldn't it?
Yeah, all we needed was somebody to agree to take less on the way up, right, and risk more on the way down. Okay, and so that's how that was worked out for him. Now, Mike, without if I'm going to show this, I should show the solution too, right?
Yeah. Okay. Well, you've shown the problem. You've shown the issues. You've shown the three players. Let's say in this instance, for the 70% of our covered call players. Now, what are we going to do about it?
Okay. Very good. Well, first of all, one of the retail players, the savvy pro, the long caller, he was only willing to he was only willing to risk 3.6%. And the other retail player was only willing to make 3.6%. And did the long call buyer practice cut your losers short, let your winners run?
The long call buyer did, yes. By buying the call and only investing $2 and keeping the risk down to 3.6% of the entire portfolio, the losers, if the position lost, it was manageable. The long call trader could suffer that loss and still be in the game. But the payout potential, if the stock would have gone to 60 or 70 or 80, was essentially unlimited. Right.
Let me also mention another thing, Mike. If that long call buyer was risking 3.6% when the stock went down 45%, if the stock, $45, 10%. If the stock went down 50%, would he lose more?
No. He still has just that allocated risk of the investment amount, $3,600 at 3.6%. The stock could go to zero, and that's still a single-digit risk of that portfolio.
Right. It's just a wiser structure. On the other hand, Mike, did the covered call seller, did he practice cut your losers short, let your winners run?
No. It did the opposite. When you look at a risk-reward profile of a static covered call position, it actually cuts your winners short, but still allows your losers to run to about 95, 97% of the invested capital.
That's right. Okay, and that's the big problem. Okay? All right, so, Mike, what did folks not know was possible? Well, I think that not everybody realizes that structure is everything. Okay? The long call buyer structured his account well. If he had bet everything, he would have lost everything.
Yeah.
Right?
Yep.
Yeah. Okay. So what we need to have is a structure, a position of strength, and begin from there. Once you begin from there, almost everything else seems to take care of itself. Okay? even selling calls. I mean, you can sell covered calls. Mike, you do it, right?
That's right.
You don't do it naked. You sell covered calls against your protected positions, okay? But, Mike, this isn't my propaganda. I stole this from Options Express, okay? They both acknowledge that a covered call and a protective put are bullish, okay? They claim that the covered call is safer, although I think some of our seminar attendees today might argue that that's safer. You know, it doesn't belong way over here, maybe more in the middle.
It's safer than owning stock, but it's not really safer than other positions.
That's right. Okay.
Well, it's safer than naked calls too, but let's.
Yeah. I don't think it belongs way to the left. I think maybe it belongs more in the middle, or depending on what kind of issues you're trading, it could belong way over here. Like I lost everything trading covered calls in the 90s before I understood about structure. Okay. All right. But Mike, what about this structure? Would you say that it's safer?
Absolutely. You know, it has a similar risk-reward profile to what we were talking about before, but in this scenario, we have a very limited risk. We know our risk going in up front, and we still have that upside profit potential.
Right. Now, here's the real kicker, okay? The reward is limited. I'll definitely go along with that, okay? On the other hand, the reward is unlimited with the protected put. Mike, if it was anything else other than the stock market, if I was to say, hey, Mike, I'm thinking of two investments. One of them, I might make as much as 5%, but if I'm wrong, I could lose a lot. On the other hand, I would say, you know, Mike, I've got another idea, and there's no telling how much I could make. You know, it looks very lucrative, but if I'm wrong, if I'm absolutely dead wrong, the most I could lose is 5%.
Right.
Which of those two investments would you say I ought to go for?
Well, I'd suggest and recommend going with selection number 2, and of course that's what I would be doing myself as well.
That is, in fact, what you're doing, isn't it?
Yeah. Well, yeah.
Okay. Now, Mike, what I'm going to do is I'm going to talk about the structure of a married put, okay? Within the last 12 months, I played Altera twice, okay? Actually, I think the last time I could say that was last Friday. But anyway, within the last 12 months, I played Altera twice. The first time I played it, I made 12%. Although the stock went up 17.3, I only made 12% because of the purchase of the stock insurance. On the other hand, the second time, I lost 5.6%, even though the stock went down by over 20. Now, if I had made 17.3 on the way up and lost 21.8 on the way down, would you say I made a profit?
No, you would have had an overall loss in your portfolio.
On the other hand, you happen to know, because you're looking over my shoulder, that when I made 12% and subsequently lost 5.6% on a very similarly sized investment, I actually came out by nearly $1,000 ahead.
Right.
Same stock, okay? Now, Mike, if that stock had gone down further, and it did, it actually went down to 31%, I would still have only lost 5.6 because of the structure of the married put.
Yeah, I could have dropped down to 60% or 70%. You still only would have had, a 5.6% loss in the position.
That's right. Now, let's talk about the players at this table. You've got the stock seller. He might be selling stock that he owns, or he might be shorting the stock, okay? It's immaterial. What he's doing is selling, okay? And then there's also a person that's selling puts. Have you ever heard of that strategy, Mike?
Sure. I'm going to sell a put. It has a similar risk-reward profile to a covered call. I'm going to potentially try to buy shares of stock at a discount, essentially assuming the stock's going to stay the same. If it moves down slightly, hopefully I'll get put the stock at a lower price, but if it collapses, I still have 95 or 97% of the risk on the position.
Right. Also sitting at this table, of course, is the market maker. We can't get away from him. And then there's me, because I'm going to buy that stock and I'm going to buy that put.
Yes.
Okay? I'm on the other side of that transaction. So these are all the folks that are sitting at the table. Okay? All right. Now, September 14th, 2010, Altera shares, 27.35. I buy a far out in time put option, 6 months away. That's also in the money. This is very different from the way a married put is normally run. My invested amount is $30.85. But I have a guaranteed exit, Mike. I can get out at $29 because of what?
Well, the put, when you purchase that put option, that gives you the right, Kurt, to sell to close your shares of stock at any time between now and expiration at the put strike price. So tomorrow or the day after you open this transaction, the stock collapsed to $1 per share, you could still get $29 back for your position.
That's right. Okay. So the real at-risk amount is the difference between what I'm spending and what I'm guaranteed I can get back no matter what. Now, that's $1.85 difference, okay? And that $1.85 set against the $30.85 is 6% of the underlying position. Mike, is this the same as a stop order?
No. If I bought Altera the same time as you, Kurt, at $27.35, and I set a 6% stop loss, if the stock collapsed 10% or gapped down, let's say 10% overnight, yes, I put in an order to close the position if it drops by more than 6%, but when it drops 10%, that 6% gets violated, I actually close out my stock for a 10% loss. What I told the market was, anytime it's below 6% of my purchase price, go ahead and sell the stock. If the stock gapped down 35%, as you saw with Digital River about a year ago, me just holding stock with a 6% stop loss would have been filled for a 35% loss on the underlying position.
Right. Folks that were in that flash crash, well, you know, you and I, we were both heavily invested during the flash crash, but neither one of us lost a wink over it. Quite literally for me, I napped through it. And you had bulletproof positions, and one position that had a maximum 1% risk to it, you know, so neither one of us was really caring about that. But folks that were playing stop orders, they were biting their fingernails up to the second knuckle, right? That was no fun. So anyway, this provides quite a bit more control than a stop order. The objection that I get from everyone is, you know, with that total cost basis of $30.85, you can't make a dime until your stock gets to $30.95.
All right, because you have $30.85 invested.
Right, but is that the truth, Mike?
Not at all. That's not how options react. Now, it is true, Kurt. Let me say this. It is true that if you held this Altera protective put position all the way to March expiration, you made no adjustments on the position over that time period, you would need the stock to be trading at $30.95 in order to make a dime. Only if you held it all the way to March expiration and had made no other adjustment over that 6-7 month time period.
Okay. And am I in control of those two factors, both of those factors? I mean, do I have to hold it all the way up until March? No.
No, absolutely not, Kurt.
Am I able to make adjustments?
Absolutely.
Yes. We're going to take a look at some of those adjustments later on, but that's not the purpose of these slides. Let's go ahead and take a look at Altera and what happened. Altera went up during the period of time that I played it the first time. It went up by 17.3, and I ended up making 12%. 12% was a pretty good return for, what was that, 7 weeks or something?
Yes, about that. Yes, 7-8 weeks.
Okay, yeah, I know it wasn't this full 2 months. I think it was 7 weeks, maybe 6 weeks. But the point is, I made 12%. The stock went up by 17.3, but I only made 12 because of the put options expense. Now, I played again, Mike, and I was dead wrong. But I could have even been deader, even wronger. All right?
Right.
And still, because of the structure of that trade, I could only lose a maximum of 6%. In this case, of course, it was 5.6%. Okay? All right, so, Mike, do you remember this poll that we did here just a little while ago?
Yes. How are we doing? How's that working out for us?
Yeah. Are you happy with your trading results? Okay. Well, the question is, are you happy with your trading results? Let me go ahead and show you this. If you limited risk, like what we showed, okay, down to 6% of the trade, all right, and in that case, Mike, I was trading 500 shares of Altera with a $1.85 risk, so it was a total of 925 risks. But I was trading in a 6-figure account, over $100,000. Okay, so it was 1% of the total portfolio. All right. So if you kept your risk down to 6% of the trade and 1% of your portfolio last year, would you have answered differently? Would it have made a difference? Would it have made the difference between winning and losing? Would you have said, great, I am happy with my trading? You know, we only had 3% say that before.
Mm-hmm.
Would you still lose, but maybe lose much less? I mean, that's a better situation. Or, you know, let's ask this. Did you honestly never take a loss more than 6%? Mike, what was the biggest loss you took last year?
Biggest loss I took this year, actually, was about 4.5%, and that was recently. I just was wrong.
Yeah, 4.5%. That's 4.5% of that trade, right?
Oh, yeah, the capital I invested in that trade,
yeah.
That represented only about 2% of my total trading capital.
Okay. All right. Just so we're comparing apples with apples, I just wanted to make sure that folks knew what we were talking about.
Mm-hmm.
All right. So let me go ahead and close this account. Close this poll. And, okay, 29% say, hey, that would have made the difference between winning and losing. Yeah.
That's good.
Okay. 50% would have said, great, I'm very happy with my trading. Great, I'm very happy with my trading. Mike, what was the percentage before?
3%, Kurt, were very happy with their trading.
3. Now, you could answer more than one of these, so that's why the totals are more than 100%, okay? But 50% said, well, you know, honestly, I might still have lost, considering what you're saying, but I would have lost much less. Okay, so about 50-50. 50% would have said, great. The other 50% would have said, well, I might have still lost, but I would have lost less. And 29% of the total audience said this would have made the difference between winning and losing.
Right.
Pretty cool. I'm going to ask, you know, well, that's awesome. I thought I had a follow-on poll, but I don't. Mike, let's jump out of this presentation and jump into the 2 other shorts, okay?
Mm-hmm.
This was a longer short because we actually kind of covered 2 different deals in it. Oh, by the way, can you see the screen?
Yes, Kurt. I have the screen up. I'm still looking at the Altera position right now.
Okay. I did want to mention this. You were talking about Digital River. With Digital River, it had an overnight gap of over 30% while I was long. But because I had the put option in place, my losses were 5.7%, not 30 plus. And this can happen. You can be looking at a nice, favorable double bottom pattern with an upward sloping handle. You can be saying, man, this is the time to get in. And then, pow, you know, the market can surprise you. And point is, like, I didn't get hurt. I did not get hurt. I lost 5.7%. By the way, could you pick out the Patsy sitting at the table when we did the Altera trade? Okay. Was it the seller of the stock?
The stock seller themselves, well, they lost money in the first time but made money on the second run, didn't they?
Yeah. See, if he was shorting stock, right, and the stock went up 17.3%, he got hurt that first time. But the second time, when the stock went down 31%, well, he did just fine. Okay. So it wasn't him. Was it me? Was I the Patsy sitting at that table?
Well, again, no.
No, because I made money on the way up, and when I lost money, I lost a very small amount on the way down. Okay, who ended up on the hook?
Well, the person in the last scenario that ended up on the hook, of course, would have been the short put seller, right?
Right. He made money the first time. Okay, because whatever he sold those puts at, you know, those puts expired worthless. Okay, but he ended up on the hook later. He ended up on the hook later. When I was buying those $50 puts for insurance, and the stock goes down to 30, you know, oh my God, it's still around 32. Or well, at the time of this writing, it was. So that was no fun. Okay, Mike, I'm going to ask another poll here to our spread traders because I know that we had some spread traders. Okay, the first trade that you did was heads I win and tails I win more. Would you dig that? Would
that sounds pretty good, doesn't it?
It does. All right, so what I'm going to do, Mike, is I'm going to show a spread trade, specifically a bear call spread, that cannot lose.
Bear call spread.
Uh-huh.
Okay, that cannot lose.
They cannot lose. Okay, and that's a tall order, but we're going to do it. Okay, and we're going to do it in less than 10 minutes. So let's close that poll and share the results. Okay, Mike, everyone that answered this poll was awake.
Okay.
Okay, so we go ahead and hide that. Do you see my marvelous trade up there?
We have the marvelous trade MLV RPM.
Very good. Okay, now just to be specific, okay, we're doing a lot of archived presentations. These are webinar shorts, and I know that the question has come through. Why aren't you showing recent trades? Well, Mike, every trade that I'm showing, or every technique that I'm showing, I have done within the last few weeks.
Mm-hmm.
Okay, every single one I've done within the last few weeks. All right, but you know, these are things that I've already got made up, and they were good examples at the time, and they're a good example still. So it's really easy to do this rather than, you know, paste together something brand new. Marvel, for example, is a company that no longer exists by itself. Marvel's been absorbed by Disney. Okay, but do we see Marvel up there, Mike?
Yep, we're looking at the Marvel trade. Yep.
Okay, now I would like to say that I hate to brag, but you know better than that. Okay, these are some Marvel Universe of characters. I should be very clear. I don't have licensing permission to use the Marvel Universe of characters to endorse radioactive trading. Mm-hmm. So obviously that's not what I'm doing, Mike. I'm just showing my devotion as a fan. Okay?
Right.
This is, of course, Dr. X and Wolverine, and guys, if you don't know who those are, we'll forgive you. That's okay. But the Marvel Universe of characters is doing very well in the movie theaters now, and the company was also doing very well before they got absorbed by Disney. Okay, so Mike, here's the deal. I had 100 shares left over from another profitable trade with Marvel. Now, without adjusting numbers, I didn't adjust numbers here. I had bought stock and also bought a put option. I had done some covered call trades and some other things to generate income in the near term, and I sold, and I got out of most of my Marvel shares, but I had another 100 shares. Now, without adjusting the cost basis, but what I had bought them at was $31.71, right?
Yes.
All right, but right at this time, the stock was trading at $35.98. So if I was to sell them right then, what kind of profit would I take?
Yeah, at this position, you'd have a $4.27 profit.
Right. Okay. Well, I decided not to do that. I decided instead to convert it to a married put, because married put is the basis, the beginning of all my trading, because I like to keep my risk very limited. Okay? All right, so I converted to a married put and was prepared to do some adjustments on the married put. Now, at this point, Mike, it was June, I think, maybe July of 2010, and the $40 put options were trading at only $6.50.
Okay.
Now, remember, I had cheap shares left over from another profitable trade. These are the 5 lines of the what I call the radioactive profit machine. First, you have the cost basis of your shares of your stock, and this is not adjusted. Okay, I had bought it at $31.71. Okay, not counting that other trade. All right. Now, what I did was add in my January $40 put option at $6.50, meaning that my total invested amount is $38.21. But Mike, what's the strike price of that put?
Well, the strike price of the put that you purchased, Kurt, was the 40 strike put. So if you only have $38.21 invested, and then at the same time you're owning a 40 strike put, well, that means you're guaranteed a profit of $1.79, aren't you? You have a negative at risk, which equates to a guaranteed profit.
Right. Now, do I have any short calls or anything limiting my gain?
No, you don't have.
Decides to go up?
Right. You don't have any short calls. You don't have any even short puts or anything like that. Right now, the position stands with a guaranteed return on the downside if the stock completely collapses, and you still have an unlimited upside profit potential.
Okay. All right. So let's take a look at that graphically using the Power Options platform. And a lot of folks that are here today are already Power Options subscribers. Okay. So you probably recognize this tool. This is a custom spread builder. And of course what I've got here is a familiar hockey stick graph, but there's something missing. Well, what's missing?
There's no red. There's no break-even line, and there's no loss. As you see down at the bottom, if over the next several months the stock's trading below 40, you're still guaranteed that $179 profit, or 4.7%.
Right. Now some folks might ask, well, why didn't I just sell the stock? Well, Mike, why don't you usually sell stock?
I'm expecting it to go up.
Yeah, and I was still expecting it to go up. But what I've done here is I've made it so that I can't give back too much of the profit. Now, I could have made $4.27 profit by selling, right?
Yes, that's right. Originally $4.27 would have been your profit if you liquidated.
Now, let me clear up what I have not done. I have not swapped $4.27 for $1.79. Have I?
No, that's not what you did.
No. Okay, I simply purchased a put option, and Mike, if I change my mind in the next 5 minutes, well, I can unwind that position and only lose on the bid-ask spread, right?
That's right. We could sell to close the put for maybe only a 5 or 10 cent difference, and then liquidate the stock, and we'd still be in an okay position.
Yeah. Okay. So just to be clear, I didn't trade 427 for $1.79. I simply added a leg to this position. Now, here's something else. Okay. I wanted to take income, and income method number 6 is something that I nicknamed "Give me my money now." And it's because I don't know what the market is going to do next, and I frankly don't care. All I want is a credit right now.
Right.
Something that's really interesting about this is it is absolutely riskless because of the context. Okay? Now, there's 9 different ways to take money out of a married put position at will, okay, without necessarily selling the stock. And if your stock pays a dividend, there's a 10th way right there, okay? I'm going to show income method number 6, which is selling a bear call spread for a credit. And you have to do this according to the dictates of my book, The Blueprint, right? Because there is a way to get, to muck up your account by doing this incorrectly, okay? But in this case right here, here's what I did. I sold the August $40 calls for $1.78, and at the same time bought the August $45 calls for 28 cents, generating a net credit of $1.50. Now, what's the normal problem with a bear call spread?
Well, you collect $1.50, but you're risking the difference in the 2 strike prices. So if the stock goes against you, you might have a 5-point risk, which would equate to about $3.50 because you keep the $1.50. But the risk is going to potentially outweigh the gains.
That's right. Okay. So let's just forget for a minute that I own the stock. If I sell the 40s and buy the 45s, and the stock ends up at 48 bucks, well, I've got an obligation to deliver at $40.
Correct.
So I don't have to go out on the open market and buy the stock for $48 because I've got a call option that says I can buy for $45. Right? So I'm going to have to spend $45. I'm going to have to deliver at $40. I've lost $5. But that $5 is offset by the $1.50 that I've taken in, yes?
That's right, Kurt.
Okay. Now, here's why I say that this is riskless, because the bear call spread itself, this particular one, risks the $3.50 difference between me buying at 45 and selling at 40, right?
Yes.
But if I have the stock on hand, do I have to buy at 45?
No, you already own the stock to cover the obligation of the short call, and you have an extra long call.
That's right. Okay, let's look at it graphically. Okay, in the context of the married put, okay, I've got the married put, and if you'll notice down here, Mike, there's a little flat line. And I've got a lot of subscribers that are doctors, and they don't like flat lines, okay? It shows that there's no life, okay? Look up here, please, at the negative 179, right?
Okay.
Look here at the negative 4.7. That's the negative risk that I have, right?
The guaranteed profit. Mm-hmm.
Yeah, and this flat line. Now let's overlay the bear call spread onto it. The bear call spread takes a credit. What happens to this line?
Well, it kind of just keeps going up. You get a little heartbeat there, and then it keeps going up after that.
Yeah, and you'll notice there's actually more space here than there used to be also.
Mm-hmm.
That more space is represented by, here my maximum risk is now negative 327. My maximum percent risk is now negative 8.9. I'm going to definitely make 8.9%. I'm going to definitely make $327. Do you see how that works?
Mm-hmm.
Isn't that cool?
Absolutely.
And Mike, if the stock goes to $48, $45, can I still make more?
Well, that's right. You can adjust the position. The blueprint discusses adjustments for each of the 10 income methods. So you have the opportunity to make adjustments on the position to potentially realize higher profits if your expectation is that the stock's going to continue to move up in price.
Right. The key to what makes that bear call spread riskless is the fact that I own stock. For example, Mike, a short call is very risky, right? I mean, just a naked short call.
Without owning stock or another call against it, it is about the most risky thing that you can do, simply because it has infinite risk to the upside if the stock continues to move up in price.
Right, but if you do it in the context of owning the stock, then there's quite a bit less risk, isn't there, to that short call, right? Yeah,
absolutely.
If the stock goes down, you keep your money, and at least from the short call. All right. Well, we're doing this in the context of a married put. All right. So the context of a married put makes this completely riskless. Okay. Now here's what happened. I'll give you the end of the story. I sold the bear call spread for $1.50 credit, and then the stock hiccuped down, and so I thought, you know what? I'd like to be long on the stock and long on one of the calls. So I bought to close the $40 call.
Which was your short call?
Cents. My short leg, yeah, which for 45 cents. Now, that locks in the $1.05 difference, right? So I've been paid, yes?
Mm-hmm.
Okay, and I still own the stock and I own the $45 call. Now, Mike, this didn't work out for me because what I thought that the stock might come back up and I'd be owning the stock and also owning the call at a credit,
right?
Which is interesting. That actually has worked out for me in other trades, but it didn't work out for me here. It worked out for me, by the way, in GameStop. I used income method number 6, got paid to own some calls, closed the shorts. I end up owning long calls and owning the stock, and the stock goes up. Marvelous, okay? But that's not what happened with Marvel. What happened was that that $45 call did expire worthless on the third Friday in August.
Mm-hmm.
But that's okay because I'm able to kind of sit and hang on my stock. You know, it's bulletproof after all. And it was the setup that was important. It was the structure. That's what I'm trying to get across. The structure of the trade is what's more important. Now, at the end of August, this is what happened. Marvel announced its plans to sell out to Disney.
Mm-hmm.
And the shares of stock went up by more than 10 points in a day. My cost basis for both the stock and the put had been $38.21, so I'm selling now for $48.41.
How about that?
Pretty cool. So during the 2 months that I was holding this stock, there was no risk of loss. Does that make sense? Just a position to hold on to and to play. I got $1.05 credit for income method 6. I got 30 cents when I liquidated that put. I got 10.20 in capital growth, so the total was a 2-month 30.2% return on an investment of $38.21, and that $38.21 was always bulletproof. Okay.
Right.
Now, Mike, I include this example because there are some folks that might be in these shoes. They might be sitting on stock that's up. And there's more than one way that we show this. For Fusion members, for example, Mike, we showed a Bulletproof Butterfly last week. Okay, Bulletproof Butterfly trade. If it closes between two extremes, it makes money. If the stock crashes, you still make money. And if the stock goes up by a whole lot, you still make money. That was kind of a unique position. But there are some folks on the line whose stock is up from where they had it, okay, and they have opportunities like what I've shown just now, and also the Bulletproof Butterfly. They have opportunities like that available to them and may not even know it. Okay, so that's pretty cool. All right, Mike, how are we doing so far? We got one more webinar short.
Yeah, we're at 12:57, right? So that's fine.
Okay, very good. Usually we finish at quarter after the hour. I'm going to do another one real fast. I'm going to ask folks on the line, what do you think of spread trades that have no risk? And
so that's the proper combination. When you think about the married put position and we think about a bear call spread in the context of the married put position, we still have a very good place where we can still keep our risks low and have the unlimited upside while generating a profit.
Right. Okay. Mike, I'm going to ask you to... Well, never mind. I'm good. Okay, let's go and leave that up for another few seconds here. Okay. And 3, 2, 1, boom. Okay. Okay, so 61% say beats the shiitake mushrooms out of covered calls. All right. And 35% say, hey, can I do that in my IRA? Absolutely, you can. Okay. By the way, if your broker seems to think that you can't, you need to talk to them. I was able to do this in a Scottrade IRA, believe it or not. Okay, and Scottrade doesn't allow spreads. Huh, interesting. But they do allow you to buy stock. They do allow you to buy puts and calls and do covered calls. And guess what? That's all what I've shown in there. After all, I've got a covered call trade. And I've got a long call that I've also purchased. So pretty cool. All right, 39% say, whoa, I didn't know you could do that. Got any more? Yeah, sure I do. I got 10 more. All right, so let's go ahead and show this. Okay. Now, Mike, we're going to show a different spread trade. This is another riskless spread. And for this, we're going to show, now, recently I did income method number 3, which you saw, right? I think it was with DEC. Was it with Deckers Corporation?
Right.
Yeah, where I took a credit with zero risk. All right, but we're going to show an older trade, okay, because I've already got the slides made up for this one. So here's Research in Motion on September 5th, 2007. Research in Motion was anticipating an earnings announcement. So the shares of stock were at 84.04, and the October $85 call. Look at how much you could have picked up, Mike, by selling that October 85 call.
That's a lot, isn't it?
That's a solid premium. Look at that. So that would bring the cost basis of the stock down to $77.94, and if you did get called out, okay, you make a $7.06 profit. Really good. Okay, really, really good. Of course, on the other hand, you're also looking at a risk, a downside risk, right?
That's correct.
Now, Mike, while I have been playing Research in Motion, one time when I was playing Research in Motion, it had a 35% overnight gap down.
Yes.
So is this $7.06 profit worth risking whatever 35% of $84 is?
So,
I think that's $26 or better.
Yeah. Steven says this is going to get ugly.
This is going to get ugly. Okay. Well, fortunately, this is not what I did. I did not short a covered call. And you know what? During this period of time, sometimes Research in Motion had surprises to the upside. Okay. All right. So here's what happened. Here's what really happened. What really happened was I did get in for the 84.04. But instead of selling a covered call, Mike, I made the investment of buying. This isn't a typo. It's the January 09. So more than a year away. $100 put option, so it's in the money also for $24.70. That brings my total investment up to $108.74, and I've got a guaranteed exit, of course, of $100. So the difference, the at-risk amount, is $8.74, or keeping it in single digits, about 8% of the underlying, married put investment. Make sense?
Makes sense, yes.
Okay. Now, here's what happened. This spread that I'm going to show responds to the market's movement. Instead of anticipating what the market may do, this is a spread that is done after the fact. Okay? So 3 weeks into this position, I sold to close the January 09 $100 put option for $19.80.
Okay.
And bought to open the October 07 $100 put option for $7.20. Now, does that generate a net credit or net debit?
Well, yeah, you sold to close the put for $19.80. We already took the price of that put into account in the overall cost basis. So you're selling to close part of that combination for $19.80. You're buying a new position for $7.20. So you're going to generate a credit of $12.60 against your total position right now.
That's right. Okay. Now, somebody might say, well, wait a minute. How did you generate a credit? You didn't sell a call. Well, no, I didn't sell a call.
Mm-hmm.
And they'll also say, well, geez, that $100 put option is worth a lot less than what you paid for it. Yeah,
True.
But you know what? This $100 put option is worth a lot less than it would have been on that same day.
Mm-hmm.
Okay? See, when the stock goes up, all the puts come down. And the puts that are nearer an expiration come down more dramatically. Yeah. This is, there's no name for this spread. Yeah, I looked. All my adjustments, not all of them, but most of my adjustments have names, like the ratio call spread, right? And we call it income method number 5 because of the context in which I do it. It's an income method, right?
Mm-hmm.
And it has no risk, by the way. If you do it correctly, the ratio call spread, which normally would have infinite risk, has no risk, right? Mm-hmm. But anyway, this particular spread, this has no risk. There's no name for it. You've likely never seen it anywhere else, okay? But, Mike, I was able to do this with one commission and still have an insurance policy in place. Let me ask you something. Am I still insured to the tune of $100?
That's correct. Absolutely.
Yeah.
You still have that protection in place. Mm-hmm.
Okay. And I've got a sooner expiration, but so what? I didn't have the intention of holding this for a year and 3 months.
Right.
I had the intention of doing a near-term play with this, okay? All right, so here's the new picture, all right? My research in motion stock had originally cost me $84.04.
Mm-hmm.
And that first put option had cost me $24.70. So my total cost basis was $108.74. Now, I do this spread by the fact that I'm closing an already open position and opening another one. It's still a spread. I'm buying one option, selling another option. That's a spread trade. Okay, so that spread brings in $12.60. So what's my new cost basis?
Now I've adjusted the cost basis by that $12.60. So your cost basis is $96.14 overall into the position.
Right, but I still have a $100 put. It's just a different expiration. What's my risk now?
Well, your risk now, again, as we saw before, is a negative at risk. In this case, we're negative 386. That's the worst case scenario. If the stock now collapses down to $50 or $40 or $20 per share, you're still guaranteed to make 386.
Yippee skippy. All right. So the fact is I've got about a 3.5% guaranteed gain.
Mm-hmm.
All right. And earnings is coming up. I sent out an email to my Fishing subscribers, which we've revamped and retooled and renewed. It's a new subscription with a lot more features and benefits. Okay, we call it Fusion now. Okay, but at the time it was Fishing. I sent an email to my Fishing subscribers saying, I know the future. And that's a really funny thing for me to say, Mike, isn't it? Why do I say that?
Well, we don't know the future. We can't know the future. If we knew the future, well, then we wouldn't need to be trading radioactively, would we?
That's right. All right, I always say I don't know the future, but I did know my future, okay? My future was that the morning after the earnings announcement, I would be tickled pink, okay? Possibility number 1, if earnings disappoint and RIM crashes, I'm happy because I just now arranged for a 3.55% profit, and I'm only 3 weeks into the trade. Okay, I've arranged for a 3.55% profit, and I can get out without any problems by exercising my put option, even if the stock gaps by 30%. Right?
Yes, that's right.
Possibility number 2, earnings announcement excites institutional investors. More pick up shares, and that drives the price up. And guess what, guys? That is what happened. What happened was the stock went up right after the announcement to $119, and it started coming back down. At $114.74, I got out, and that was a 6-week, 16.23% gain.
But that's not
actually it was
important.
that's not impressive. And by the way, that 16.23 does take into account commissions. It does take into account commissions. It'd be 17.1 otherwise. Now, Mike, if I had sold a covered call, if I had sold the $100 covered call, I'd feel like a chump, right?
Absolutely.
Yeah, because either the stock would have gone down and I would have gotten hurt, or it would have gone up and I would have had to take only half, a little less than half of the profit that I did. Interesting, because a covered call limits your upside, and a Mary put leaves it open. And so that was the deal. Okay, we began with an 8% risk, adjusted it to a negative risk before the earnings announcement, and then after the earnings announcement, of course, ended up with a double-digit 6-week gain. Pretty cool? Pretty cool. Okay. All right. So I'm going to run another poll here, and I'm going to ask folks what do you think was the most important part of today's lesson. Mike, I'm going to need to take care of something here real quick. Like, can you shut down that poll and share the results, and then take folks to our order page?
Sure thing.
Very good. Okay, I'll be right back.
All right, so we're going to leave the poll open here for a minute, and of course what we're just saying is what is the question Kurt wants to know is what do you think is the most valuable part of today's lesson? Is it the limiting risk aspect? I apologize. Is it seeing how the put could be used to generate income? That was with income method number 3, what Kurt likes to call the bulletproof vest. Seeing how a spread could take income and leave the top off. Remember, that was income method number 6, the bear call spread and the proper structure of an RPM. And that the structure of a trade is more important than the trade itself. We're going to leave this open for another 10 seconds. Okay. And about 5, 4, 3, 2, let's go ahead with a 1 there. All right, I'm going to close the poll down now. So if you haven't voted, I'll give you another 5 seconds. 5, 4, 3, 2, 1. All right, let's go ahead and close the poll, ladies and gentlemen. Let's share the results with everyone. 21% think that limiting the risk to single digits is something way better, is the most valuable part of today's lesson. The winner, of course, 43%, is the structure of a trade is more important than the trade itself. Okay? There's a lot of customers I talked to over the past 8 years here at Power Options who thought they'd found a good trade, whether it was an iron condor trade or even just a long call trade or even maybe just a standard covered call, and they put too much of their percentage capital at risk in the position, and it went against them. And then the structure is very important. Our second place is bulletproofing, is that's taking the position from a limited single-digit risk to no risk. Now, earlier we did have a question from one of our attendees who wanted to know, so when you set up the married put, are you planning on holding the position all the way to expiration and doing adjustments in between? Well, actually, the blueprint teaches the proper technique. We're typically not planning on holding the position all the way to expiration. If I open a put that's 8 months out and 6 months into the trade, I still feel there's potential for upside, I'm going to look to increase my time on that. I'm going to look to roll it out perhaps further in time. There are ways to do that as well. But the idea is that you can set it up to a bulletproof position and then still realize the unlimited upside profit. And then, of course, 11% were excited about seeing how the put could be used to generate income. Yeah, there's a lot more to radioactive trading than just buying the stock, buying 6-month out protection, 8-month out protection, and, oh, we're just going to sell a call against it. No, we can manipulate that put using the 3 core principles of radioactive trading, which Kurt discusses in the Foundations of Radioactive Trading Mastery CD. I bring that up for a specific reason. And there's also other methods that can be done that aren't just capping the gains by selling a call. There's 10 different income methods, some that are used in a bullish market, some that can be used if the market is stagnating or declining in price, and others if the market has fallen as well.
Very good.
Are you back with us,
hey,
sir?
Mike, I'm back. I
Okay.
sure am, yep. I needed to, now you've got the control of the screen, right?
I actually didn't grab it, so hold on 1 second here.
Oh, you didn't? Oh, okay. I was just sailing through this other larger presentation to get to a place where we can make our iridium offer.
Okay.
And okay,
What
good.
in the? Okay, there we go. All right, so hold on 1 second, ladies and gentlemen. Let me go ahead and hide those results. And sorry about this little thing here. There we go. Over here, we're at Radioactive Trading, and we're at the Products tab. And Kurt, why don't you talk a little bit about that?
Oh, very good. Okay, the Radioactive Trading Home Study Kit, now we are selling this whole system for lower than we ever have, I believe. There's a 35% discount when you consider all the products that we normally would sell separately in here. Okay, the blueprint is normally, I think, $339. You want to scroll down? Scroll down a little bit, Mike. Okay. The blueprint is normally $339, and it does come with a money-back guarantee. We're very confident that, I mean, if you were pleased with the income methods that we shared today, the things that we're comfortable showing for free, you'll be really happy with the income method adjustments and the setup techniques that are in the paid materials. Okay? $339 is what we normally charge for the blueprints, and we guarantee it. Okay, Mike, if you were trading a married put and the most that you could possibly lose was $339, but you had an unlimited upside, would you say that that was a pretty good play? You know, if you were playing it within a $10,000 account or so.
Oh yeah, because the opportunity for unlimited profits are there, and it's no risk.
Okay, well, you'd have $339 risk. Right? With a married put. But if we bulletproof that married put, if we did some kind of adjustment that took in an income or at least adjusted the risk to where there was no more risk anymore, then it would be, well, riskless. And when we don't have any risk, but we still have the possibility of an upside, that's what we call bulletproof. Okay, so that's where the bulletproof, the blueprint is right now. If it doesn't measure up to your expectations, go ahead and send her back. It's really easy.
Yeah.
Okay? And if she does measure up to your expectations, Mike, I've gotten letters where folks have written me and said that they have saved or made 100 times the cost of the blueprint with their trading accounts. So it's a pretty good investment. Let's scroll back up. Okay. The home study course includes all the material that's in the blueprint. It includes the blueprint itself, and also a lot of things off of the CDs. That the CDs themselves are $89 a piece. Okay, but we're throwing them all in. All right. Mike, I'd like to change presenter here real quick, and I'd like to give an offer, a special offer. To folks. Is that doable? Can I steal it?
Yeah, go ahead.
Okay, very good. All right. So, folks, we've got an end-of-year promotion going on. I want to know what you would like to do next. Okay. Would you like for me to give you more free stuff? Because today we had a free presentation. It was pretty cool. If you want some more free stuff, would you like the blueprint, or would you maybe like both? What do you think? Okay, some folks are texting in. Okay, all right, let's go ahead and show you how to get some free stuff. Okay, copy this down for free stuff. The word testimonial. Okay, testimonial. If you'll send me an email at kurt@radioactivetrading.com, put the word testimonial in the subject line, and inside write to me your biggest aha moment from today, I'll send you a free video. Okay? That free video is going to have another riskless spread trade, one that we didn't even show today. Okay? All right. Your exclusive free video is going to include a spread trade that's done in a credit. It also has zero risk. This trade can be done in an IRA. All right?
Yeah, I have to. Yeah, once you get through this, I have to address some questions here.
Okay.
And yeah, they're pretty important. Gentleman online, Jeffrey here, is sort of saying something here that's don't necessarily agree with, but I want to bring it up to the audience and allow you, of course, to answer it as well.
Okay, very good. The first 10 letters, folks, that write to Kurt at RadioActiveTrade.com with the word testimonial inside on the subject line, and within your biggest aha moment from today, okay, will receive this free video. Okay, allow some time for me to read through those testimonials, make sure that it's, for real, and just tell me your aha moment. And the first 10 letters are guaranteed to get that spread train. Okay, there's that. And then opportunity for some free stuff with the blueprint. Okay, copy this down for, whoops, okay, we already said this for the absolutely free stuff. Okay, now how about for the blueprint? Okay, copy this for some free stuff with the blueprint. Einstein. Okay, put call me in the subject line of an email with your biggest reason for or your biggest objection to getting the blueprint right now. Put Einstein and call me in the subject line, and guess what? The first 10 letters will get a consultation with me, and also at least 2 free products to go along with your blueprint purchase. And by the way, if you go ahead and buy your blueprint or buy your home study course first, you'll still get those bonuses. Does that make sense? You'll just find out what they are later. But it's got to be the first 10 letters. Okay, so let's be quick about that. Okay, Mike, I'll go ahead now and take those questions.
Well, first, sidetrack Leonard. I'm going to answer you after the email. Leonard answered about updating his 3-year-old blueprint. Leonard, I'll send you an email after the presentation. Very quick, Jerry, just want to say if you think the presentation is good, you should see the coaching that goes along with the subscription. Jerry's a member of Power Options, of course, and has had some of those coaching sessions with me about the Power Options tools and the techniques as well. Now,
thanks, Jerry.
Jeffrey said that, now I'm going to rattle off 3 quick points in a row, Kurt, and then we can address them all. Jeffrey, I believe, is a new member coming to the audience, and these questions are great, don't get me wrong. But I don't exactly agree with some of the comments. And Jeffrey said that bulletproofing is only possible after a favorable move, right, meaning up. What about a negative move? And then he said income method number 1 is a collar, that income method number 3 you showed is just a calendar spread. This is just catchy names for old ideas.
Okay. Let me address the last one first.
Sure.
Number 3 is not a calendar spread. We're swapping a far spread for a near spread. If you were to simultaneously sell a far out in time put and buy a near in time put, it would not be a calendar. It'd be a very risky move is what it would be.
Yeah, it's sometimes referred to as a reverse calendar, and it's not something that's widely used. But we're not selling to open one and buying to open another either. We're selling to close an existing put and buying to open a shorter term put to limit the risk of the position. It's sort of like rolling in.
Yeah, that's a truly original spread, and a Chicago floor trader wrote in to me when I first shared this in 2003. He wrote in to me and said, Kurt, that's sheer genius. You need to write a book. And that was the catalyst. Actually, it was 2002. That was the catalyst that got me to write the blueprint in the first place. So that is a completely new trade. However, many of the trades I already disclosed are known trades. It's the context that makes them unique. Okay. All right. What was the 2 other comments that?
I'll answer this one if you don't mind, Kurt. You could chime in too. But income method number 1 is a collar. It is and it isn't. It is, but it's not done at the same time. And a collar doesn't have to be. A collar, by definition, is any time you have a combination of long stock, long put, and short call. Whatever your expiration date of the put is, whether it's in or out of the money, whether the short call is at, in, or out of the money, that's fine. It's the first income method that Kurt came across because everyone knows it. Whoever researched covered calls or was qualified to trade options or applied to trade options, that's the first thing they were allowed to do. But the collar is not set up at the beginning point. The rules in the blueprint dictate that you're going to wait for the stock to move before selling the call. You're selling a call against a Mary put, which does create a collar, and that's how it is called in the blueprint. It's just the first income method. That's all. And in essence, once you create it, it's a collar, but it's a collar done after the fact. That's the thing. Some of these income methods you saw, the income method number 6, Kurt referred to it as a bear call credit spread. but it's a bear call credit spread done after the market has made a move in the context of a protected position, not anticipating what the stock's going to do next, but reacting after the market has already made the move.
Yep. Yeah, the reason we call them income methods is that they're adjustments that are made to an existing position along the way. And so, no, they are very unique. Okay, and what was the first question?
Oh, well, bulletproofing is only profitable after a favorable move. What about a negative move? Well, in the blueprint, there's a whole thing. Well, yeah, in the blueprint, though, there's a whole example. There's a whole chapter on the Hewlett-Packard example that Ernie did, where the stock had declined in price and he had made a profit. One of my first radioactive trades was on Office Max. I opened the stock at about 20, opened a 22.5 put at the same time, followed the rules in the blueprint. Over the next 5 months, the stock dropped 75% of its value down to $5 per share. I was long stock the entire time and got out with a 1.5%, 1.8% return. Now, am I bragging about a 1.8% return over a 5-month period? Well, kind of, because I was long stock the entire time and it was down by over 75%. And also...
that was the crash, wasn't it, Mike?
Yeah, that was during the crash.
Late 2008. And while many folks were taking big hits in their accounts, you actually were able to adjust your stock plus put position and get out at a small profit rather than, the 40 or 50% loss that folks were experiencing across the board.
That's right.
That's exciting. It's exciting to take a small gain instead of a loss.
Right.
Pretty cool.
And then another comment that came in is that your FAR premiums seem really low in your examples. From experience, that's not what I see. Thanks anyway. But yeah, when we set up the positions, we look for the proper positions when you're using the criteria for the RPM, or even when I use different criteria that Kurt uses based on my account size. Okay, so am I paying some intrinsic value? Yes. Am I paying maybe 10% or 8% over the stock price for intrinsic value? Yes. But all we're risking is the time premium. I'm opening a position that has only a 4 or 5, maybe a 6% risk for an 8 to 10 month period, and I have 8 to 10 months to easily bulletproof that position and earn extra profits. And if the stock drops down 35%, I only have a limited loss. Now, this isn't for everyone, but these questions are great, and we appreciate that, Jeffrey. I mean, these are
Jeffrey
questions
says,
for us.
in his experience, you can't get that? Well, what about my 10 years of experience trading these puts? Everything I've done is a matter of public record.
Yeah.
Everything I've put out there, even critics, I had a fellow in a Yahoo forum criticizing my work, and we've actually become friends, and he's actually invited me to speak for his group since. But back then he issued a challenge, and guess what I did? I copied him on the fills of my DIA position.
Right.
It's still posted. It's still posted out there. That was back in 2006, I think. But and as recently as last week, I've been doing these trades. So, I don't know if experience is what you can draw on if you haven't been trading married puts for 10 years.
And those are common questions that come up, and we just like to handle them. And we just got another question come in from Gunny, who asked about...
Hey, Gunny. I spoke with Gunny. He's a gunnery sergeant, retired, right? I spoke with Gunny here a little while ago. How's he going?
Yeah, well, he's going well, and he had some other good questions. He was the gentleman, of course, that asked about do you hold the position all the way to expiration, or do you adjust it? And I mentioned him what's in the blueprint and how we approach that, and what the SIGA model is. But the other question is, we get this from time to time, and Gunny, I'm going to send you an email after today's presentation. And Gunny, of course, wanted to know, instead of initiating a married put, would it be better, less costly, to purchase a call at or in the money and then buy the same in the money put than manage the same way? No. And I'll send you a couple of emails that we have with those comparisons, what's called an in the money long strangle, Gunny, and why it doesn't work the same way as a married put position. It's
a good question. It shows that you're thinking, but no. And if we're going to talk about experience shows that it's not a good idea. Very good.
That's right.
Okay. Mike, I'm going to go ahead and close her up and start answering some of these emails.
Great.
And folks, if I don't get your email right away, please understand the sheer volume what we've got to deal with. It does take some time. Thank you, Gunny, for your service. I think anyone that serves in the military deserves a nod, and I sure do appreciate you and what you've done. And Mike, thanks for having me as your guest. And let's see, we're not going to do a webinar on Thursday like we normally would, but we will be doing a special presentation next week.
Absolutely.
So very good. Okay, everybody.